Hi, this is Mike from DIY Domination, and I want to ask you, have you set your financial goals yet? If not, it's high time to do so. Setting financial goals is not just about dreaming big, it's about crafting a strategic blueprint for your financial future. This involves establishing both short-term and long-term objectives. Short-term goals could be saving for a vacation or paying off a credit card, while long-term goals might include buying a home or planning for retirement. Understanding your risk tolerance is another crucial step. Risk tolerance is your ability and willingness to lose some or all of your original investment in exchange for potential financial gain. It's a fundamental aspect that shapes your investment decisions and guides your asset allocation. That is how you distribute your investments among different asset classes like stocks, bonds, and real estate. Remember, clear financial goals are the foundation of any successful investment strategy. To make informed investment decisions, you need to understand your current financial situation. Let's begin by calculating your net worth. This is the total value of what you own, your assets minus what you owe, your liabilities. A positive net worth means your assets exceed your liabilities, a good place to start when considering investments. Next, review your income, expenses, and debts. Knowing where your money comes from and where it goes is crucial. It gives you a handle on your spending habits and helps you identify areas where you could save more. Then take a closer look at your current investment holdings. Are you heavily invested in stocks, bonds, real estate? Understanding your current investments will help you identify areas where you need more diversification. Having a clear picture of your financial situation is key to making sound investment decisions. Remember, knowledge is power, especially when it comes to your finances. Now that you've assessed your financial situation, it's time to create a budget and establish an emergency fund. Let's start with budgeting. This is a crucial step to ensure you have sufficient funds available for investing. To create a budget, first, take a good look at your income and expenses. Understand where your money is coming from and where it's going. Then, allocate a portion of your income specifically for investments. Think of this allocation as paying your future self. It's not an expense, but a way to grow your wealth over time. Now let's talk about the emergency fund. This isn't a luxury, it's a necessity. Life is full of uncertainties, and having a financial safety net can help you navigate through unexpected expenses without derailing your investment plans. Aim to set aside 3 to 6 months worth of living expenses in an easily accessible account. This could be a savings account or a money market fund. Remember, this money is for emergencies only, not for splurging on a new gadget or a vacation. Establishing an emergency fund may seem like a daunting task, especially if you're starting from scratch. But don't worry, you don't have to do it all at once. You can start small and gradually build up your fund over time. Every little bit helps. Once you've created a budget and started building your emergency fund, stick to your plan. Review your budget regularly and adjust as needed. Life changes, and so will your income and expenses. Make sure your budget reflects these changes. A well-planned budget and a solid emergency fund can provide financial stability and pave the way for successful investing. It's like building a strong foundation for a house. The stronger the foundation, the more resilient the house is to storms. In the same way, a robust financial foundation can help you weather economic downturns and keep your investment goals on track. So take the time to create a budget that works for you and start building your emergency fund today. Remember, every journey begins with a single step. Your journey to financial freedom is no different. Investments come in various shapes and sizes: stocks, bonds, real estate, and more. These are typically referred to as asset classes, and each comes with its own set of risks and rewards. Stocks, or equities, represent shares of ownership in a company. They are often considered the most volatile asset class, but they also have the potential for the highest returns. Bonds, on the other hand, are essentially loans you make to a government or corporation. They are generally considered more stable than stocks, but their returns are usually lower. Real estate involves the purchase of physical property, which can provide income through rent and potential appreciation in value. Then we have alternative investments such as commodities like gold or oil and private equity. These can offer diversification benefits, but they also come with higher risk and are less liquid than stocks and bonds. Now let's talk about asset allocation. This is the process of deciding how to distribute your investments among different asset classes. Your asset allocation should be based on your risk tolerance, time horizon, and financial goals. Risk tolerance is your comfort level with potential losses. If the thought of your investments losing value keeps you up at night, you might have a low risk tolerance and would want to allocate more towards bonds and less towards stocks. Your time horizon is the length of time you expect to hold your investments before needing to access your funds. If you're investing for a long-term goal like retirement in 20 years, you can afford to take on more risk with a higher allocation to stocks. Your financial goals also play a role. If you're saving for a down payment on a house in 5 years, you might lean toward a more conservative allocation to protect your investment. There are common models for asset allocation, such as conservative, balanced, and aggressive. A conservative model might involve a higher percentage of bonds, a balanced model an equal mix of stocks and bonds, and an aggressive model a higher percentage of stocks. Remember, a well-balanced asset allocation is crucial for managing risk and achieving your financial goals. This isn't a one-time decision, but something you'll revisit as your life circumstances, goals, and the economic environment change. With your asset allocation in place, it's time to select specific investments. When it comes to stocks, you have several options. You can invest in individual companies, which allows you to potentially reap significant rewards if the company performs well. However, this also exposes you to the risk of the company underperforming. Another option is to invest in exchange-traded funds, or ETFs. These are investment funds traded on stock exchanges, much like individual stocks. ETFs offer a way to buy a piece of a diversified portfolio in a single transaction, which can lower your risk compared to buying individual stocks. Mutual funds are another excellent choice for diversifying your stock investments. These funds pool money from many investors to purchase a wide variety of stocks, bonds, or other securities. They're managed by professionals who make the buy and sell decisions. When it comes to bonds, you can consider government bonds, which are generally considered safe but offer lower returns. Corporate bonds issued by companies usually provide higher returns but come with higher risk. Municipal bonds issued by local governments can offer tax advantages. Bond funds, like mutual funds for stocks, offer diversification and professional management. Now, let's talk about international diversification. By spreading your investments across different countries and regions, you can reduce the risk associated with any one country's economy. International diversification can also provide exposure to emerging markets, which can potentially offer higher returns. Remember, investing in international markets comes with its own set of risks, including currency risk and geopolitical risk. It's important to research and understand these risks before investing. Also, don't forget to diversify within each asset class. Don't just buy stocks from one sector or bonds from one issuer. The goal is to spread your risk across different types of investments, sectors, and geographic locations. Diversification, both domestic and international, can help spread risk and potentially increase returns. So as you select your specific investments, consider how each one contributes to your overall portfolio's diversification. Investing doesn't end with the purchase of assets. Regular rebalancing, tax-efficient investing, and staying informed are all part of the game. Just as a gardener tends to their plants, so too must an investor nurture their portfolio. This involves regular review and rebalancing. Let's say your original plan was to have a 50-50 split between stocks and bonds, but a year of booming stocks leaves you with a 70-30 split. You might need to sell some stocks and buy bonds to get back to your original plan. This is rebalancing. It helps you stick to your strategy and manage risk. But while you're busily buying and selling, remember, Uncle Sam is watching. Taxes can take a bite out of your returns, so it's important to invest tax efficiently. This might involve utilizing tax-advantaged accounts like individual retirement accounts or 401ks, which offer tax deductions, tax-free growth, or tax-free withdrawals in retirement. It's like having a shield against the taxman's arrows. But even the best shield can't protect you if you pay too much for your investments. Minimizing costs is key. Choose low-cost investment options like index funds or ETFs. They can help reduce expenses and increase your returns over time. After all, a penny saved is a penny earned, and while you're saving pennies, make sure to keep your ear to the ground. Staying informed about economic and financial news can help you make better investment decisions. But beware of making impulsive decisions based on short-term market fluctuations. Investing is a game of chess, not checkers. It requires strategic thinking and patience. Remember, investing is a long-term journey, Stay patient, stay informed, and keep your portfolio aligned with your goals. The road to financial success is not always smooth, but with a well-diversified portfolio, you'll be better equipped to weather the bumps along the way. And remember, no matter how the market swings, keep your eyes on the prize, your long-term financial goals.